In this video, we talk about how balanced investing helps in the long run. Hi, my name is Shyam Ganesh and I'm with Grow Your Wealth Financial Planning. I often get the question, how does balanced investing help in the long run? So I want to give you some background on what is balanced investing. Why would someone choose that type of an investment? So a balanced investment typically refers to a medium risk portfolio. And the way that a medium risk portfolio is put together is typically with a combination of stocks and bonds. Now, stocks are ownership in companies that is the side of the investment that's supposed to grow. So if you own something, if you own a stock of Google or of RBC Bank, then you expect it to grow and appreciate in value. Now, the thing about stocks is that it can also be fairly volatile. And by that I mean if the stock market crashes 30%, well, each of those two stocks I named are going to crash some proportion of that. It's very unlikely that if the market as a whole crashes, then these particular stocks were somehow left untouched in that meltdown. And so the balance comes in when you also add, and typically you add the safer component, and typically that safer component is bonds. So most mutual funds, most ETFs that are balanced will hold a combination of stocks and the safer side, which is the bonds. And what are bonds? Bonds are essentially an IOU. So you give $1,000 to the government of Canada or to a utility company, and they give you a particular return for X number of years. So a 3-year bond may have a 2% yield or a 5% yield. All that means is you give them $1,000, they give you 2% a year for 3 years or 5 years. And so that's the side that's supposed to be safe. It gives you a little bit of income, and it also gives you some stability. Now, bond values, they can fluctuate as well, and actually they do fluctuate. And especially in a low interest rate environment as we are now, as interest rates go up, bonds are going to fluctuate downwards. Nevertheless, in the long run, bonds are a good diversifier in a simple investment approach, with a simple balanced investment approach, because it does give you that income, and if you hold it all the way to maturity, then it'll give you your $1,000 back. And so it's a good diversifier. The other reason to have this combination, and so a balanced fund would typically have a 50-50 or a 60% stock and a 40% bond allocation. And the nice thing about that is when stocks rise, so stocks will rise faster than bonds typically. So if stocks gain 10% over any given year, but bonds only increase by 3%, well, if you started with a 50-50 portfolio, at the end of a year, it's no longer going to be a 50-50 split. And that means you are now taking more risk than you signed up for, because in a balanced portfolio, you're saying, I don't want more than a medium level of risk. Well, as stocks grow more and more, you get to 60% and 70% and 80%. Essentially, you're taking more and more risk. And so what a typical balanced portfolio will automatically do is also sell some of the stocks and buy some of the bonds. And this is cool because even without you doing any work, essentially you're always going to be selling the thing that has grown. So you're going to be locking in some gains and buying the thing that is a little bit lower. So you're always taking gains where you can, and that's what you want, right? You want to be able to buy something low and sell something high. So the concept is called rebalancing. Again, around the balanced approach, you rebalance to get it back to what you started with, and that actually guarantees success for you in the long term. So that's what a balanced investment approach is, and this is how it helps you. If you are an investor who does not like to see a lot of volatility in your portfolio, that is, you are not comfortable having a 30, 35, 40% drop in your portfolio when the stock market crashes, a balanced approach might be more appropriate for you. You will make a little bit lower of a return in the long run, but you will see no more than 15 or 20% drops in your portfolio, which is still quite significant, but you will see some growth as well. And so really the question is, what fits your risk tolerance? And if it is kind of medium risk and you don't want the full extent of the volatility, then a balanced approach is an excellent one. And as you grow your portfolio, your options for what comes into the stock, the equity side or the growth side, and what comes into the fixed income side, in place of bonds or in addition to bonds, your options increase. But a balanced portfolio, basic one, great place to start as an investor. Thank you so much for watching this video, and comment, share, like below, and let me know if there's anything else you'd like me to answer.